So this is our BDA. We are tackling topic number 3, where we are going to do the preparation of the financial statements. That's where we are. Preparation of financial statements 3.0. Now, if I look at this, yesterday, if you can recall what was done, we were able to look at April setting, part A of that question. You are told to do a trial balance without bringing in the adjustments or the omissions. That's what we did yesterday. From the trial balance, we were able to identify what the items that should have debit balance, those that should be having credit balance. So we were just given general figures without any arrangement. That is what was given to us. At least today you can see we have debit and credit. So it means we've already been given a trial balance. Yesterday we prepared a trial balance. So when we now come to this particular question today, all of us should be able to understand what a trial balance is. All of us should be able to understand what a trial balance is. But then we have additional information down here. I don't want to subject you to this additional information until we're able to understand or prepare these statements without any additional information. We are just given a trial balance. So we have Baraka Limited. The following trial balance was extracted from the books of Baraka Limited as at 30th April 2022. So this is the trial balance of Baraka Limited, account, debit, credit. That's what they have mentioned there. So it is upon you to know that, is it that what is given to me, is it that whatever has been given to me is an asset? Is it a liability? Is it an expense? Is it a capital? Or is it a revenue? Is it a revenue or an income item? That's what we all need to understand. Once that is understood, then we can proceed to prepare the two statements that are required here. I want us to do this with these great people here. I want us to start with the profit or loss, which we normally call statement of comprehensive income. Statement of comprehensive income for the year ended 30th, is it 30th? 30th of April 2022. That is what we have. That is what we have, 30th of April 2022. So we have to know the name of the company, which is Baraka Limited. Baraka Limited. Statement of comprehensive income for the year ended 30th April 2022. So that's what we have. Now, when we are going to prepare our statement of comprehensive income, we need to know what are the items that you're going to have here. The first thing that we should look for, is there someone who can help us to identify? So let's just analyze this first. We have land and buildings. So land and buildings, if it is given at cost, we expect something called accumulated depreciation or depreciation expense for the current year so that we get the net book value. We have fixtures and fittings, that is non-current asset. Machinery and equipment, non-current assets. Inventory is a current asset. Debtors control, that is the debtors, is 0. Bank, current asset. Capital is equity item, so we have it there. Loan, that is a long-term liability. Creditors control, that's a current liability. Sales, that's a revenue or income item. We have sales returns. Yes, we sold goods, but customers have returned back some goods to us. Cost of goods sold, we have it there. So once we have cost of goods sold, they have not given us purchases. So it means they have already worked out the purchases. But then in our yesterday's discussion, when we were looking at April 2023 setting, question number 25 from an 1, we were able to see on how to calculate the net cost of goods sold. We were able to have purchases there, returns outwards, carriage inward, discount received, such kind of things. We were able to look them or use them and see on how we can arrive at the net values of both purchases and revenue. We have advertising costs, that's an expense, membership fees expense, water and electricity, telephone expense, salaries and wages expense, interest paid is an expense. So it is just as simple as we are seeing it here. I want us to use this simplified thing to calculate everything. That is the statement of comprehensive income and also statement of financial position. So what will be our first item in the profit or loss account? What will be our first item? What will be our first item? So Fozia is telling us that the first item which you are going to have here is sales. So let's have the sales. So we're going to have sales. Of course, I'll just pick it here because I'm having the advantage of Excel. I just extract it from this particular point. That is sales. So this sale is not the net value. There are some goods that were sold, but the customers returned them. So what are we going to do? Less sales return. Less sales return. Less sales return, which is equivalent to, so if you look at this, we have 50, but this 50, remember it is a positive. Our statement is saying that we less sales return. So what are we going to do? Indicate equal and negative, then you refer to 50. It will give you negative 50. So any other thing that will be affecting our sales omitted item, we don't have any additional information. So what do we call it? This one here, net sales. So that is the net sales value. That is the difference between those two, which is 47,980. So that's our net sales value. Then after getting sales there, we are now going to look at the cost of sales to get gross profit. So for us to get cost of sales, it is opening stock, add purchases, less returns outwards, add carriage inward to get cost of goods available for sale. And then we subtract the closing inventory for us to be able to get cost of goods sold. But this person here, or in this particular question, all that was done. The only thing we are given here is the cost of goods sold. So let's bring our cost of goods. Cost of goods sold, we are able to see it is equivalent to this. But because we are going to less it, for us to get a gross profit, you can just have it here or indicate a negative against it. So our gross profit is equivalent to net sales minus cost of goods sold. That is the gross profit. I don't want to proceed beyond that point before I confirm that we are together. Just confirm to me that all of us are having 34,920 as their gross profit. That is what I want you to confirm to me, that all of us are having 34,920 as their gross profit. Okay, we don't have any other income. The revaluation gain to be under the comprehensive income. We don't have gain on disposal of an non-current asset. We don't have discount received. We don't have income from rental houses. Why are we lessing cost of goods sold? Yes, Ododa, that is a good question. So yesterday, we normally get our net sales. How do we get gross profit? It is the sales minus the cost of goods that we've sold. Those costs are directly related to the goods. So, for example, we are going to have opening stock. Opening stock, Then we add purchases when you take just a simple one here. Then we add carriage inward. We add carriage inward, then we less return outward. Return outwards for us to be able to get cost of goods available for sale. Cost of goods available for sale. So once we get the cost of goods that are available for sale, we did not sell everything. There were some that were left in our stock, and that's why we call them less closing stock. If that is done, then we'll be able to get what we call cost of goods sold. Cost of goods that were sold. Is it now making sense to you, Ododa? So the cost of goods that were sold, we are getting by working out all this information. Is it now making sense? Okay, so that's done. So after getting our gross profit, because we don't have any other income item, we are going straight away to operating expenses. We just indicate expenses. We are going to expenses. And the first expense item that I'm able to see here, I want you to mention them as I write them down, because by doing that, I will be able to know whether we are understanding something. We are able to extract information from yesterday's discussion and bring it here. First expense for this particular question. Our first expense, we have advertising. We have advertising, so we can have it at this particular point. Advertising is equivalent to this value. So as you mentioned, you write it down. We have membership fee. We have membership fees. I can just come and bring mine here. But what I want us to do is to refer to those figures. So just say we have membership fee. I come and pick it from this point. After membership fees, I'm able to see water and electricity. Water and electricity, what do we have there for water and electricity? That is it. We have telephone. Yes, thank you, Nick. We have telephone expenses. That is it. Salaries and wages. Salaries and wages, we have it there as 28,000. Interest paid. So remember, in some questions, they'll just give you the interest rate. They will not give you the interest paid. So it's upon you to know the amount paid, to know the accrued amount, what to put in the profit and loss account, what to take to the balance sheet under accrued expenses. We should be able to know all that. So once we have the interest paid, do we have any other expense that we've left out? Do we have any other expense that is left out? Believing that there is none, we can get the summation of these expenses. We can get the summation of these expenses. And then from there, we are able to get our net. We're able to get our net profit. Net profit is equivalent to gross profit less interest paid, less total expenses. So we have it there as our net profit. Of course, it is net profit or loss. And since that is a negative, we are going to have our net loss. That is the net loss value. That is the net loss. That is the net loss value. Now, here, remember this one here is not always taken to our balance sheet directly. No, we don't always transfer this figure to our balance sheet directly. What we do, this is the loss or profit for the year. So this is loss. It is net loss stroke profit for the year. In that particular year, that is how the company did its transactions. But then we are going to do what we are going to add. Can someone tell me what you are going to add here? If you really did FR, FA, then there's something that we need to add. What are we going to add here? Other comprehensive income, yes. We are going to add other comprehensive income, that's good. And then once other comprehensive income is added, of course, that's what will give us the net profit for the year. Then we are going to add what we call retained earnings. Retained earnings brought down or brought forward. So once, if we had our retained earnings brought down there, we write it. So for our case, it is 0, so that we get what we call retained earnings carried. Discount received, that's an income, so we could have placed it under other income, maybe below gross profit for us to get other income. Then we are going to get total income. Could have placed it up here. So as you always transfer your balances to the statement of financial position, know very well that you will not take profit for the year. You will take retained earnings carried down, which is the summation of profit for the year and also retained earnings brought down. So this is our figure. It happens that retained earnings brought down is 0, and therefore this figure is the same as what we have here. But what we are transferring is not net profit or loss for the year. We are transferring retained earnings carried down. Tuko pamoja? Are we together? Are we together up to this particular point? Are we together up to this particular point? Okay, if that is making sense to all of us, then I want us to move forward to prepare statement of financial position. I want us to move forward to prepare statement of financial position. So I can just have maybe this information here, and then I call it statement of financial position. Statement of financial position, where the question only asks for. Statement of equity. Statement of changes in equity, we don't need that. We don't need statement of changes in equity here, because the examiner requested you to prepare the two. Statement of equities, no, we are not going to prepare it here, unless you are going to maybe prepare the published account, something of that kind, which is also having a different format. So statement of financial position as at as at 30th April 2022, we are going to have our non-current assets, which you can call it PPE, but for your interest or for the benefit of everyone, our non-current assets are these 3 items. Those are the ones that I've been able to see. So just come here. That's the advantage of working with Excel. You don't need to write. Just come and copy. Once that is copied, you'll be able to see you have brought them here. So our non-current assets, the 3 of them, I just come and pick the values. I just come and refer to these values. They are following each other. They are following each other. So as a good person, I just come and autofill the 3. I'm done with the non-current assets. So I come to the total of these non-current assets, that is the summation. So we have total non-current assets. I have to come now to current. Current assets, the first thing there is inventory. Inventory, I'm able to see we have debtors, which is 0, so there's no need of indicating it there. We have bank. We have, I think it is only bank that is there, and inventory. So we come and extract the two values of inventory, and then we get the value for bank. That is it. So total current assets, total current assets, the summation of the two, and then we get total assets. Total assets now will be the summation of total non-current and total current assets. So that is the total assets, which we expect to be balancing with what we are going to get under financed by equity and liabilities. Equity and liabilities. Equity, there's a question here. Debtors control, the figure is 0. So if it is 0, there's no need of bringing it here. It will have no impact. It will not affect the balancing figure of this. So equity and liabilities, we start with equity. We start with equity. We start with equity. And our first item for equity, we have capital. We have capital. Then we bring in reserves. We bring in reserves. We bring in reserves, and reserves here, that's where we have revaluation reserve, general reserve. That's where we have share premium, which is not here, So if that's not there, we also have retained earnings or revenue reserve, which is what we now extract from this point. So what I was talking about, this is what we bring. This is what we bring to this particular place. It is the reserve that we are talking about. So capital, we pick it from which point? Here is the capital. And then retained earnings, which happens to be our negative figure, that is it. If there is no any other reserve, then we call it shareholders. Shareholders equity. Shareholders equity is the summation of everything that is here. That is capital plus any other reserve. So these are our shareholders equity. Then we come to liabilities. The liabilities, now you're going to have non-current liability. Non-current liability, I want somebody to tell us the non-current liability that we have here. Somebody to tell us the non-current liability. The non-current liability that you are able to see, even though it is not clear, but you can take it as non-current liability. Somebody to help us identify that. So this non-current liability, remember, we have been given loan there. So we are assuming that that is a long-term loan, though it is not clear. In some questions, it will be clear. They will tell you that this is the current or non-current liability. So for our case, we are going to pick the loan figure as a non-current liability, unless there is any credit control that is not non-current. That is going to fall under current liability. That one is going to fall under current. That one is going to fall under current liability. So under current liabilities, we pick the figure that we are being given by Fozia here, the item there. We have the first item there is credit control. Credit control, which is equivalent to 5670. Any other current liability? Any other current liability? Of course, accrued expenses could have been placed there. Accrued expenses could have been placed there. Do we have any other that is remaining? Do you have any that have skipped? I think we've captured all. So we can now go ahead to get interest paid. That was an expense. It was already paid. It was already paid. They indicated it is interest paid. So if it is paid, it only finds its way to statement of comprehensive income, not statement of financial position. So we are now able to get total liabilities. Total liabilities we are able to get. We just add our liabilities here. And then total equities and liabilities. Total equities and liabilities should be the summation of total liabilities and shareholders' equity. If I add that, I should be able to get total equities and liabilities, which becomes the balancing figure under this section. So if we get the summation of total equities and liabilities together, compare that with the total assets, is it going to balance? Are we going to have a zero difference? So I get the difference between these two. I get the difference between those two, and it confirms that it is zero. So these figures are equal and the same. What does it imply? It implies that our balance sheet is perfectly balancing. Our balance sheet is perfectly balancing based on the information that we've extracted, from this simple trial balance. From this simple trial balance. Are we together? Are we together? Are we together? Are we all getting these balancing figures? Are we all getting these balancing figures? Are we all getting these balancing figures? Yes. Okay, so if that is done and it is understood, I want us to now move to another question where we are going to apply the concept which we learned yesterday. What are these concepts? Depreciation. So we are now advancing. Remember yesterday, we were given the depreciation value. Today, we are given the depreciation rate, and we are expected to do what? To use that rate to get the depreciated amount. And then from that point, we should be able to get net book value, which will be transferred to our statement of financial position. So to that effect, I would like us to move to this particular point. Yesterday, we prepared a trial balance. So in our today's discussion, you're able to see that we are only given trial balance and some additional information. This other one, there was no any other additional information. But to this, we were given, or we have been given additional information down here. But what are they giving us at the start? A trial balance. So we all know what a trial balance is. So this is what we have. The following trial balance was extracted from the books of Bahati Limited as at 31st of March 2023. So we have ordinary share capital, 10% preference share capital, then share premium, 8% debentures, accounts payable, accounts receivable, sales, purchases. You're able to see where they are placed. Bank overdraft, that's a liability. Discount received, income item. Discount allowed, expense item. Buildings at cost, that is non-current asset. Fixtures and fittings at cost, that's an asset, and of course non-current. Accumulated depreciation, the reduction in value of the non-current assets due to wear and tear or due to usage. And the next item down here, we have inventory at the beginning of the year. And then if you're given inventory at the beginning of the year, you're able to see we now have purchases. So what are we going to do? We are going to calculate the cost of goods sold by ourselves. They have not given us that. We have to calculate it on our own. Then we have return outward. We purchased goods and returned them. So it's going to reduce the value of purchases. Director's fee, those are now expenses. Administrative expenses, selling and distribution. Bad debts written off, those are expenses. Allowance for doubtful debts at the beginning of the period. That is provision for doubtful debts. Retained profit as at 1st of April 2022 is this figure. But when is the financial year ending? 31st of March 2020 or 31st of March of every year. So this is what we call retained earnings brought down. In this question, our retained earnings brought down. Our retained earnings brought down was 0. In this other question, it is not going to be 0. It is going to be 90/50. So I believe we've now seen what we have just discussed sometimes back there. Investment at fair value. Investment at fair value, that is now the financial assets. The financial assets are not being depreciated, but you just look at the fair value at the end of the year. Is there increase or is there a decrease in the fair value adjustments of these particular assets? So if there is increase, of course, that's going to be a gain. We take it to the section of other or CI. Then we now look at the additional information. So the first thing that you need to do is your trial balance balancing. That's the first thing. If you're not given this total, you have to confirm. You have to confirm. So when you talk about fair value or DODA, if you look at the fixed assets, we are given the depreciation rates or the depreciation amount as to the other question. But then the investments are now given to us, or they are being valued by an expert who knows how to. For example, if you want to know the value of a motor vehicle, or you want to know the value of a piece of land, then you take a surveyor who will tell you that this piece of land, if you sell it as at today, it should range between this given amount. So we don't have a fixed rate to depreciate our asset or a fixed rate to appreciate our asset, for example, land, but you just look for a valuer to tell you the value. So the amount or the value that they're going to tell you at that particular time, at the end of the financial year, is what we call the adjustment, the fair value. So if that fair value is adjusted, you compare the fair value at the beginning of the year with the fair value at the end of the year. Is there a difference? That difference, is it a positive or a negative? Then that we now see on how to treat the two, either the positive or the negative one. Is it now making sense to you? Is it now making sense to you? I believe so. So we have additional information here. The company maintains a gross profit margin of 20%. Then as at 31st of March 2023, accounts receivable balance included 250,000 due from a customer who had been declared bankrupt. So the accounts receivable is going to be reduced because it includes a given amount for a customer who is not going to pay. So the bad debts written off is going to increase by 250,000. It is going to reduce our accounts receivable. It is going to reduce our accounts receivable. The allowance for doubtful debts is to be adjusted to 5% of the accounts receivable as at 31st of March 2023. The accounts receivable value that we are going to subject to this 5% should be the net amount. So we first of all get our accounts receivable we subtract the bad debts written off, or the doubtful debts that has been written off, this 250. The amount that is remaining is what we subject to 5%. That 5%, we compare the 5% with, the provision. So will there be an increase or decrease in the provision for doubtful debts? If there's increase in provision, it means it is more than the provision. So that will be an expense. The difference will be an expense. If it is going to be less than the provision, then it means the provision was exaggerated, and therefore we call it now an income. We put it under income. As at 31st of March 2023, administrative expenses accrued amounted to 175,000, while prepaid selling and distribution expenses amounted to 75,000. The company paid interest on debentures for the year ended 31st March 2023 on 5th of April 2023. The financial year ends on 31st of March, but interest is being paid on 5th of April 2023. So what are we doing? It means as at the last day when the financial statements were prepared, these people are not paid the debentures or the interest on debentures, and therefore it becomes an accrued expense. So it will be there in the income statement as an expense, and also in the statement of financial position as accrued liability or accrued interest. The depreciation is to be provided as follows: 2% per annum on cost. Then fixtures and fittings, 10% per annum on reducing balance basis. The company's directors propose that the preference dividends be paid. The preference dividends, remember, they are subjected, or they are supposed to get a fixed dividend amount, a fixed rate. And you're able to see here that it is 10% preference share capital. So 10% of the preference share capital value is what will give us the dividend amount. So they proposed that the dividends be paid. They just proposed a dividend of 10% on ordinary shares be paid, and then shillings 2,500 or 2,500,000 be transferred to general reserves, other reserves. When we transfer this to general reserves, we are going to reduce the retained earnings carried down to be transferred to the statement of financial position. So by just doing that, by analyzing that, I think we are now ready to move with speed and calculate these 2 or 3 items required. That is the value of inventory, and then statement of profit or loss for the year ended 31st of March 2023. 31st of March 2023. So let me just see if there's anything here. Do you have anything here to take care of? Do we have anything here to take care of? Okay, let me make it to be here for us to do away with this column. And they're the only things that are there. What if I take them to this side so that I have so that I also do away with this other one. Let me do away with this other one here. Okay, so you can have it at that point. Let's now look at it from this particular point. Now, let us look at it from this particular point. the first thing that I want us to do is to get the value of inventory as at 31st of March 2023. The value of inventory. So they purchase some goods. So the inventory, the closing inventory, how do we get closing inventory? 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 Which account are we going to prepare for us to be able to get the closing inventory? Which account? So remember, they are not giving us the closing inventory, but then they are telling us that the company maintains a gross profit margin of 20%. The moment we see margin, profit margin, then it means it will always be divided by, the sales. Our denominator will always be sales. The moment you see the word margin, denominator will be sales. So this additional information, number one, is what will save you, or is what will help you to get the closing inventory value. So if you are in our yesterday's session, you will be able to tackle that. But I want us to take it from this direction. We normally have sales to start. So we have sales. Do we have sales, or how do they call it here? Sales revenue. It is the same thing. So we have sales there. We have sales there as 120,000. Then these sales, maybe there are some customers who returned goods. So do we have return inwards? Do we have return inwards or sales return? Do we have return inwards? Do we have return inwards in this particular question? Do we have? I think there is none. So after getting sales, we are going to move to cost of sales. We are going to move to cost of sales. And under cost of sales, we start with opening stock. We start with opening stock. We add purchases. These purchases here, maybe we might be having return outwards. Return outwards should be subtracted. If we have carriage inward, it should also be included there. But let me see if we have it in this particular question. Do we have carriage inward? No. So if there is no carriage inward, then these items here, opening, add purchases, less return outwards, will give us cost of goods available for sale. Cost of goods available for sale. Then we less closing stock. When we less closing stock, we are going to get cost of goods sold. We are going to get cost of goods. We are going to get cost of goods sold. So opening stock, do we have it? Do we have it, the opening stock in our question here? Inventory as at 1st of April 2022 is our opening stock. We add purchases. We add purchases. Do we have purchases here? Yes. Then we less return outwards. I can just indicate a negative there and pick my return outwards, which you are able to identify is here. And then we get cost of goods available for sale. So it is opening stock, add purchases, less returns outwards. So because I've indicated a negative, I just get the summation of this. And because these are negative, it will reduce that. Of course, this one here is 116,000. minus 2, I expect to have 114,000. That is the cost of goods available for sale. Then I less closing stock, which is X, to give me cost of goods available for sale. So cost of goods available for sale is equivalent to, cost of goods sold will be equivalent to cost of goods available for sale less closing stock. Less closing stock. So let's say I have 0 there for now to get just a value. That is it. That is the cost of goods sold. From there, when I get the difference, I'll get what we call gross profit. I'll get what we call gross profit. So gross profit is equal to sales. I want to take sales minus cost of goods sold. So this is the sales minus cost of goods. Sales minus cost of goods sold. It is giving me gross profit. But gross profit margin, what have I said that gross profit margin? Gross profit margin formula. Gross profit margin, it is going to be gross profit over sales, and not just sales, net sales. So gross profit margin is equivalent to, what are they telling us here? Gross profit margin is equivalent to 20%. Gross profit margin is equivalent to 20%. So this value, this 60, this one here, this 6,000, it should be 20% of sales. It should be 20% of sales, which means our cost of goods sold should be the remaining percentage. If I add these two, if I add gross profit back to cost of sales, I should be able to get my sales value. So the other portion that is missing before I arrive at gross profit should be the cost of goods sold. It should be the cost of goods sold. Now, I want somebody to help me understand what will be the cost of goods sold if gross profit margin is equivalent to 20%. So what is 20% of the sales value? Our gross profit here, we are being told that it should not be that 6,000. It should be 20% of the sales. So it is 24,000. My question now is, what should I subtract from 120,000 to get 24,000? What should I subtract from 120,000 to get 24,000? Are we still together? Are we still together? Okay. Sasa hapa watu wamepotea. We have sales. Let me make it simple. We have sales, then we have cost of sales. We have sales, then we have cost of sales. So our sales is 120,000. Our cost of sales is 80,000. Our gross profit will be automatically 120,000 minus 80,000 to give us 40,000. I believe we are now getting this. Sales minus cost of sales will give us gross profit, which means this cost of sales and the gross profit, if you add them together, they will give you the sales value. But now we want to express them as a percentage of sales. We want to express them as a percentage of sales. So what percentage of sales do gross profit represent? What percentage of sales do cost of sales represent? If I want to get the percentage of the ratio, I will take sales divided by the sales value. If I want to get this, I will take, no. If I want to get the ratio, it is going to be, let's check the formula for our gross profit margin. It is gross profit over sales. If I want to get cost of sales ratio, it is cost of sales over sales value. If I want to get gross profit ratio, it is gross profit over sales value. So these are the percentages, which are, so just come and insert the percentage. So we are able to see them there. Well, let me just reduce it to that point. So these are the percentages we are talking about. And this gross profit ratio is what we call the gross profit margin. Is what we call the gross profit margin. That is what we call the gross profit margin. It is that gross profit divided by the sales value. Now we do not know all these things. We do not know all these things. Well, the only thing we know is that, so let me do away with all this. We do not know anything there. We only have sales and we have gross profit margin. So if we take gross profit, we divide by sales, we are going to get 20% or 0.2. Gross profit X over 120,000 is equal to 20% or 0.2. Now, if I want to get X, what am I going to do? If I want to get X alone, X over 120,000 is equal to 0.2. What am I going to do? I'm going to multiply both sides by 120,000. Therefore, my X will be equivalent to 120,000 is equal to 120,000 times 0.2. And that 0.2 is this 20%. So what am I having as X? 24,000. What was this X? It was the gross profit. So I come to the gross profit section here and put my 24,000. If gross profit is 24,000, so here, my gross profit here is 24,000. And how was I arriving at 40? I was taking 120 minus 80 to give me 24. So what will I have here for me to get 24,000? I will take 120 now minus 24 to give me the real cost of sales is equal to 120 minus the gross profit, because I've been given it here. So I'm working backwards. I'm working this backwards to be able to get the cost of sales. So you are able to see that my cost of sales is 80%. My gross profit margin 20%. That is what the examiner has given you. So we've known our gross profit is 24,000. Our cost of goods sold is now the difference between sales and gross profit. So it's going to be 120 minus 24,000. Tunapata 96. Cost of goods available for sale is 144,000. For me to get cost of goods sold, I will subtract closing stock. 144,000 minus unknown should give me 96. So what is this unknown that reduces 144 to 96? What is this unknown that reduces 114 to 96? Yes, let's see that. Let's see that if we will be able to calculate it. Let's see. What is it that we are supposed to take away from 114,000 to arrive at 96,000? 114 minus 96, we have 18,000. So if I take 18,000 away from 114,000, I'll be able to arrive at 96. I'll be able to arrive at 96,000. So I simply come here and say 144 minus this 190 or minus 96, I'll be able to get the real figure, the 18,000 that I'm looking for, that closing stock. So this one here is what you are required to calculate in part 1 of this question. is what you are required to calculate in part 1 of that question, because you know it will be a balance sheet item. It will be a balance sheet item which we need to have in place. So are we now okay? Are we now okay with the first part of the question? If a question is given to you tomorrow, you are given closing stock, you are given cost of goods sold, but you are not given opening stock. Will you be able to do that? Will you be able to calculate for us the opening stock? Okay, so it means we've been able to understand what was required there. So once that is done, the gross profit margin will not be useful to us. We are not going to stop at this gross profit. We are only going to stop at that gross profit. So we now proceed. After gross profit, do we have any other income? Do we have any other income? Other income, we have discounts. Discount received. Discount received. You're able to see the 325. That is the discount received. Any other income that is here? So any other income? It should be on the credit side. Do we have any other income here? These ones here are capital or equities. Here we have a revenue item. We only have that. Bank overdraft, that's a liability. Then discount received, I'm able to see just that one. Any other income item? Any other income item? Maybe if you look at the provision, whether there was an increase or a decrease in provision, then you will be able to know that. So having done that, we can now go and deal with the workings down here, because once we are through with the workings, we'll be able to solve this question perfectly. So additional information number 2, as at 31st of March 2023, accounts receivable balance included 250,000 due from a customer who has been declared bankrupt. Another thing that we need to take care of, these 250,000, remember up here, they're putting it in thousands. So if you're going to subtract it from the accounts receivable here, you don't subtract 250,000, you subtract 250 from 8250. We subtract. So you can have T account or just do it directly. Whichever option you pick, you will still be able to calculate that. So I have, let me just do it down here. I have accounts receivable, accounts receivable, accounts receivable, accounts. So let me just have it here. Let me just have it here. So these accounts receivable, that is an asset account. So do we have anything in the name of do you have anything in the name of balance brought down? So balance brought down, let's say that is what is there. So just pick this figure that is given to us is equal to 8225. So out of this, there's a customer who is being declared bankrupt. They are not going to pay this amount that we expect them to pay. So are we going to reduce the account, or we are going to maintain it? The accounts receivable. The accounts receivable, we are expecting 82. 8250. We are expecting 8250, but someone has already given us signs that they are not going to pay it. Why? They have been declared bankrupt. So we are going to reduce it by 250,000. I mean 250. This 250, they are not going to pay us. We are writing it off. When we write it off, we take it to bad debts written off account. We take it to bad debts written off account as an expense. So we take it to bad debt written off expense account, and then in that particular expense account, it will be transferred to the profit or loss account as an expense. So we are going to have here to bad debts written off. We are going to take it to bad debts written off. Of what value? 250. So if we take it now there, they are giving themselves an allowance. So the provision for bad debts also reduces our account, the expected amount that we expect to receive. The provision for bad debts, provision or allowances for doubtful debts. So the provision here is to be adjusted to 5% of accounts receivable. So as at the last day, this is what they indicated, 8250 that is receivable. But then this amount included 250 that is going to be written off. Once that is taken away, we need to get net accounts receivable amount so that we take 5%. We know very well that generally 5% of these people will not pay as the amount. So this 5% should also be taken for us to get the real accounts receivable. Is it? So when we want to now take that, we are going to reduce our accounts receivable again by 5%. So provision for bad or doubtful debts. It is either bad or doubtful debts. So provision for bad or doubtful debts, we are being told that it is 5% of the net. It is 5% of the net debtors value. So the net debtors value is equivalent to what was there at the beginning of the year or at that point minus what will not be paid in the name of a bankrupt debtor. That value which we are going to get, we are having 8,000. This 8,000, we only need to get 5% of it is what will not be paid. 5% of that amount will not be paid by these people. So it is 400. This 400 will reduce our accounts receivable. So it means what we are going to take to the statement of financial position as the net accounts receivable is now the balancing figure. So I want you to give me the balancing figure. The balancing figure, so that both sides, of course, I'm able to see this side is more than this. So I particularly bring it down here. I bring it down here. But then I need to have 8250 both sides. I'm already having 650. So to balance the account, what do I need to do? To balance the account, what do I need to do? I will take this minus what has been taken away. So my balancing figure is 7600. So if I go to the statement of financial position under current assets, in the section of accounts receivable, I am going to insert 7,600 as my value. I am going to insert 7,600 as my value. Is it now making sense to somebody? Is it now making sense to somebody? Is it now making sense to somebody? So that is what we need to do. But then this is what has been adjusted. The 5% of the net account receivable amount is 400. Let's go to the provision. Let's go to the provision at the beginning of the year. At the beginning of the year, they add an allowances. The allowances for doubtful debts as at 1st of April was 450. But then the real doubtful debts that they are having here is 400. So is it an increase or decrease? Is it an increase or decrease? Is it an increase or decrease? Provision. Is it an increase? So that is brought down. We can call it that. So at the beginning, they provided 450. At the end, we are having 400. So what has happened? That is decrease in provision. Decrease in provision. Decrease in provision is now giving us what they provided. They expected, they anticipated that they are going to have what? 450 as bad debts. But then at the end of the year, they now realize that it is 400. So that is now decrease in provision. And that decrease in provision is an income. That decrease in provision is an income. It is an income. So they have received 50. They have received 50. So that's what we have. That's what we have here. Discount received, then decrease in provision. Decrease in provision. Decrease in provision for bad debts. We have 50, which is an income. Do we have any other income? Do we have any other income? Any other income item? I think they are only those ones, but maybe if there is any, we are going to see them as we move forward. So total income. Total income will now be the gross profit plus other income. That is our total income. We come to the expenses. Expenses section. Expenses section here. Do we have any expense that is touched under additional information? The first one that we are able to see is bad debts written off. The value of bad debts written off has increased. So what I want you to do to save on time as you work on these things, just look for the expenses. We have discount allowed, that's an expense. We just bring it here. We have director's fee, administrative, selling, bad debts written off. All those ones are expenses. We bring them down here. And any other that we are going to have. So we have been able to see, that the bad debts written off has increased due to this debtor was been declared bankrupt. The 250, you are able to see that we transferred it. We transferred it to bad debts written off account. And bad debts written off account, I think we were able to tackle that yesterday. We take this, we are crediting this account. So we are going to debit the bad debts written off account. And for us to balance that account, we transfer that balance to the profit and loss account. We transfer that to the profit and loss account to balance that account. So the bad debts written off, as we are going to deal with it up here, bad debts written off, we will simply take what we already have. We'll take what we already have at the beginning of the period, then we add to the 250, which has been increased in the current year. So we've now dealt with the bad debts written off of the customer who has been declared bankrupt. As at 31st of March 2023, administrative expenses accrued amounted to 175,000. So accruals, how are we going to treat the accruals? Administrative expenses have been accrued. The current year administrative expenses is 3650, but then there was some amount which was not paid in the previous year. Of what value? 175. So first of all, it increases the expense amount here for the admin, and then the accrued amount will be taken to the liability section, the current liabilities, accrued expenses. So we add to 175 to it. That is administrative expenses. Then we now move to, while prepaid selling and distribution expenses amounted to 75. So selling and distribution expenses have now been paid in advance. The expense for the current period is 41.75, but then there was some amount which were paid in advance. So it reduces our expense, and then we take it to the liability, to the current assets sections as prepayment. We take it to the current assets section as prepayment. So that is what we have been given about in additional information number 4. The company paid interest on the debentures for the year ended 31st March 2023 on 5th April 2023. So it means there's another thing that we are able to see here. Interest on debentures. Interest on debentures, what was the rate? It is accrued. So one, it will be an expense and then taken to current liabilities as an accrued expense. So debentures here, we are told that the debentures value is 8%. 8% is the interest rate of the debentures value, which is 2,500. So that entire interest is accrued. So this one will be also a liability. Then we have depreciation is to be provided as follows. So let's deal with this depreciation, and then we come to these other simple things that are down here. The depreciation, one is on reducing balance, another one is on cost. So those who are here yesterday, they're also able to see how we are going to deal with. They are able to see on how we deal with the depreciation. So let me just pick this one here. It will be our reference point. I come here. I have all of them. Let me just bring all of them down here. Let me bring all of them down here. So the first one will be land. Let me just pick the first asset, then we see what we're supposed to do. How many are they? We have buildings, fixtures, and fittings. There are only those two. So let's deal with buildings. Let's deal with buildings, then we see. Let's deal with buildings, then we see what we are talking about. Buildings, account, then accumulated depreciation. Accumulated depreciation. Then depreciation, depreciation expense account. So the assets, the building should have a balance brought down. Building accounts, remember the asset here, we are told depreciation is 2% per annum on cost. So if that's a straight line, it will remain constant. It is 2% on cost. It is a constant figure. So it means the value of this asset here, this building at cost is 22,500. It will remain constant all through. It will remain constant all through. So what I need to do is to indicate 22,500. That is the balance brought down. Then balance carried down, because I'm maintaining the account at cost. It will not change. It will be like that for the lifespan of this particular asset. But then balance brought down at the beginning of the year of accumulated depreciation, we said yesterday that it should not be on the debit, but should be on the credit side. So balance brought down there. Balance brought down should be equal to what is given up here. Let's see. The balance brought down for the accumulated depreciation as at 1st of April 2022 is 6250. So I simply come down here and indicate my 6250. From this 6250, I should be able to get the depreciation expense for the year. I should be able to get depreciation expense for the year. How do I get depreciation expense for the year? We are told that it is 2% of cost. It will not change. So is equal to 2%, is equal to 2% of cost. Where is the cost? The cost of that building is this one, which does not change. So that's the depreciation expense for the year. So that when I want to get now balance carried down at the end of the year is equivalent to the balancing figure. That is the balancing figure of that. So my balance carried down of accumulated depreciation is 6,700. Then I will come to depreciation. Remember, where is it taking me to? Depreciation. So I come to depreciation account, balance brought down. It does not have balance brought down or carried down. I basically have it as whatever is coming from the accumulated depreciation account. They are bringing me a figure of 450. To balance this account, I transfer this to profit and loss or income statement, IS. I take it to IS. I take it to IS for this account to balance. When I take it to IS, then I'll be able to see my depreciation expense account is now balancing. I take it to IS. So when I come to income statement, this is what I'm looking for, which I need to put here under depreciation. So when I'm going to have depreciation, of course, I can combine these assets, depreciation expense. Depreciation expense, I'll be taking that value, but because I have two assets, I want to repeat this entire procedure for the other assets. I want to repeat this entire procedure for that other asset. Control V. Let me have the other set here, but not going to be, it is not going to be building, but fixtures and fittings. Fixtures and fittings. Fixtures and fittings, accumulated depreciation, then depreciation expense. So the fixtures and fittings now is going to be different. We are being told that it is being depreciated on cost. I mean, on reducing balance basis, So what we need to have here, is that the depreciation will be reducing. The depreciation will be reducing the cost of this asset in the same account. So my balance brought down, or my cost of this asset, the cost. So we have cost is 6,000. Whatever has been depreciated is 1,400. It means I'm able to get the net book value. So I have 6,000, 1,400 is there, and then it is being depreciated at 10% per annum on reducing balance basis. So let me take the cost first. 6,000. 6,000. Let me bring it here. 6,000. Then this 6,000 here is the cost, but it has been depreciated. It has been depreciated up to or by 1,400. So our balance brought down in this account, the net book value of this asset, should be 6,000 minus 1,400. So that's the balance brought down in this asset. account. So we maintain it at cost maybe at that point. And then when we come to accumulated depreciation, we've been able to see that we have 1,400. We'll be able to have 1,400. Depreciation expense for the year, we are told that it is 10% on the cost, on the net book value, not cost. It is 10% on the net book value as at that date. So it will be 10%. It will be 10% times net book value. Net book value will be the cost, will be the balance brought down as at the beginning of the year, will be the balance brought down at the beginning of the year, minus the accumulated depreciation at the beginning of the year. So if I do that, I'll be able to get depreciation expense of this value. Balance carried down is now the balancing figure there. Then I get my value. Depreciation expense will be this 460, which I will be taking to income statement, So once I've dealt with those two assets, I can now proudly come to this section here and insert the depreciation expense for the year. So depreciation expense will be equivalent to, I come to depreciation expense for the building. This one here is what I'm taking to income statement. And then I add to what I'm supposed to take to income statement for fixtures and fittings. So that is what I was required to do for depreciation expense. What next? After depreciation, I'm told the company's director proposed that the preference dividends be paid. They just proposed that the dividends or the preference dividends be paid, and then the dividends of 10% on ordinary shares also should be paid, 10% on ordinary shares. So the preference, so dividends, we can combine them for preference and ordinary. We can just combine them. So we are being told is equal to the preference shares. The preference shares is 10%. So the dividends is already given because that's a fixed rate, 10%. 10% of the preference shares value. Then that we are going to add to what have we been told about this one here? A dividends of 10% on ordinary shares be paid. So this one also they have decided to put it 10% plus 10% of the ordinary share capital. That is the dividends that they have proposed to be paid. It has not been paid, they have just proposed. So what is it telling us? We are going to have dividends payable in the statement of financial position under current liabilities. After the dividends, what are we having again here? This one here to be transferred to general reserves. So this one here will basically reduce. This one here will basically reduce what we have down there. Then there's nothing that is remaining there. So we can now have all these expenses adjusted. So the total expenses, will be these ones here, and then we get profit for the year. Profit for the year is the difference between total income less the expenses. That is profit for the year. Then we have retained earnings brought down. Retained earnings, brought down. We edit, it was given to us somewhere here. Retained earnings brought down. This is it. so that we have our retained earnings carried down. So when we add that, that is 22,390. Let me see, somebody saying here, per value of 10. Yes, the par value is 10, but they have not said it is based on the par value. They are telling us that a dividend of 10% on ordinary shares to be paid. It is 10% on the ordinary shares, and ordinary shares is 15,000. Ordinary shares is 15,000. Hiyo iko sawa? Is that clear? Is that clear? Okay, so there's something here. There's something here that we also need to look at up here. There's something that we need to look at up here. This transfer to general reserve. So if you're not going to include it here, it means you should have a statement of changes in equity somewhere to take care of that. And if you do that, it means dividends should not also be placed here. But because we've placed our dividends there, before we get to the retained earnings carried down, we can reduce it. We can reduce it by taking now the transfer to general reserves. We can put the transfer to general reserves here. If you're not going to prepare the statement of changes in equity to give us the net values, because whatever is being transferred to general reserves, reduces our retained earnings. It reduces the value of retained earnings. So we can have our dividends there, but transfer to general reserve is not an expense. Transfer to general reserves is not an expense. So we can just have it here after the profit for the year. We have general reserve. We can have general reserve of 2,500. Of course, it reduces the profit for the year that we're going to transfer there. So what we can do is basically indicate a negative there. Then we'll take good care of this value here. So once that is done, we can now move very fast to prepare our statement of financial position. But time cannot allow us. So what should we do? Can I leave you with the remaining part? You try doing it until Monday. Can I leave you with the remaining part? Statement of financial position. So we cannot go beyond this hour. I just want you to go and try doing the remaining part. Of course, it is very simple. What you need to keep in mind is the prepayments that we add here, is the accrual which we add here. This interest on debentures was not paid, so it is a liability. These dividends have not been paid, they are provisions, so you are going to put them under current liabilities. And then this general reserve is going to be in the equity section. We have also to put it there to reflect. It has to be reflected there, because remember, it should be reducing. This profit for the year only that we are distributing it, some portion is going to general reserve. So you've seen the effect here. We have to take it back to general reserves. Yes, please, but you need to be sharing the recordings. Can someone tell us if yesterday's recording was not provided? It was provided actually.